Welcome to Concrete Conversations, the Indian real estate podcast, where we converse with some of the brightest minds in real estate to demystify the industry. Today, we have with us our first returning guest, the founder and CEO of MYRE Capital, Aryaman Vir.
Since we last spoke to Aryaman, MYRE's user base has grown by a factor of 10 and they now have 30,000 registered investors and assets under management in excess of 175 crores.
Although he joined us on the show last year to talk about fractional ownership, today Aryaman joins us to talk about his exciting new venture at MYRE, the launch of a real estate-specific AIF.
MYRE have described this AIF as a first-of-its-kind SEBI-regulated neo-investment fund and is going to invest in A-plus grade commercial real estate properties which will be tenanted by blue-chip tenants over long-term leases.
But what is an AIF? How does it differ from other private sector investment options in real estate, such as fractional ownership? What has the journey in real estate been for a tech-enabled startup like MYRE? And what does the future hold for investors in Indian real estate?
Stay tuned to know the answers to all of these questions as we have an exciting episode lined up for you today.
Aryaman, welcome back to Concrete Conversations. Great to have a returning guest. How are you doing and how's the year been so far since the last time you were on the show?
Hi Akshay. Great to be back. So a lot of action since the last time we spoke. The year's been very exciting. In fact, the whole category is evolving and more and more investors are sort of coming on board. So it's a very, very exciting space, fast-paced industry and a lot of action planned for the upcoming year.
Right. And speaking of the action that you have planned, we know that one of the big things is the AIF. So before we, get into the meat of the subject and break it down for the listeners, can you tell us at the very get-go, what is an AIF? How does it work for investors? And how does it play into your product offerings?
Sure. So AIF is an alternative investment fund. So this is one of the more traditional funds, when one thinks of SEBI-regulated fund investment. So this comes under that category. There are three different types of AIFs, category 1, 2, and 3. But predominantly, we'll be focusing on category 2. So that's basically, the framework under which real estate investments are done under the AIF provision of SEBI.
Right.
So, this is a mainstream fund whereby the investors sort of deploy capital into it. And MYRE effectively takes care of that and, invests into the underlying asset classes based on the investment strategy.
Right. And what made you think of creating an AIF? And is there anything about the structure of this particular vehicle that led you to make that choice?
Yes. So, we got a lot of inbound interest from institutional investors, from large family offices. So these are quite different from your individuals. So, when these institutions sort of want to invest, they have a very strict guideline. They have investment committees. And one of the standard requirements for them is that, the product has to be entirely regulated and under the purview of SEBI.
Right.
So AIF comes under that framework. Now this does come with its own limitations, such as a much higher ticket size. It's effectively a sort of blind pool fund where the assets get identified subsequently, which is a bit different from what we've traditionally been doing. But overall, it's to cater to this different types of demand that we are getting inbound. We decided to launch this in parallel to our current fractional ownership platform.
Right. And since you mentioned, that you're launching these in parallel, I thought that just for the benefit of our listeners, we could make the clear distinction between these two products. So if you were to describe the differences between the way this AIF works versus the more traditional fractional ownership offering that MYRE is offering, to its investors.
Sure. So that's actually an interesting distinction. So some of the features of a fractional ownership platform that distinguish it from a mainstream fund is, there are actually three key features. The first is that there's visibility into the asset that you're going to be investing into from day one. So, the property is identified, negotiated, and it's a single property. More importantly, the returns of an investor are directly correlated to the performance of the underlying property.
Right.
And overall, the investor can see end-to-end what he's receiving. The second part to this also is that the minimum investment size. So in a AIF, your minimum investment size would be about 1 crore. It would be in a blind pool fund, which means that first we would raise the capital based on an investment strategy and thereafter identify the specific assets.
Right.
So that's the key difference. Whereas in a fractional ownership platform, minimum investment is 25 lakhs. So that caters to a different kind of investor. Now, our approach is such that, because a retail investor prefers lesser risk, more stability, we are going for the most secure belt of commercial real estate assets on our fractional platform.
Right.
So these are completed properties with freshly executed lease agreements with MNC tenants. However, the more secure your offering becomes, not only in real estate but in any asset class, the returns also tend to become dampened. So, on the contrary, in our AIF, we have that flexibility of sort of taking late-stage construction assets, vacant assets, which we are able to acquire attractive values. So the entire approach, the investment thesis to both of these will be different based on the risk appetite of the participating investors.
Right. So, if I were to just draw a comparison for understanding's sake, would it be fair to compare this the AIF offering to something like more akin to a private equity fund, then, which is meant for niche, more and probably institutional investors?
Absolutely. So it will be a private equity fund of some sorts, where we'll predominantly be focusing on real estate, but a large variety of real estate. All the way from under construction to greenfield to vacant assets, distressed assets, which may not necessarily be, yielding on day one, which may not have a rental on day one.
Right.
But in time, we anticipate that if we are able to sort of deliver the value add and execute, we'll get a significantly higher upside.
Right. And I love the fact that you're opening the roads to us, sort of breaking down the business model of this AIF now. One of the first things that we thought we could ask you is, I know you touched upon this a little bit, but can you break down the target audience for the AIF? What kind of institutions would you be referring to when you say institutional investors as opposed to retail investors and such on?
Sure. So before I get into that, there's a very interesting part about an AIF. So in an AIF, I'm allowed to raise funds from foreign investors. So these are outside of the purview of NRIs. These are actual foreigners.
Right.
Whereas in the fractional platform, we are limited to residents and NRIs. So, coming back to your question, our intention is to also start catering to foreign investments in India.
Right.
Now I'll just spend a moment on that. So, your Blackstones, Brookfields, and funds such as this, they have the capability of setting up an entire vertical, locally in India itself when they want to sort of undertake a business initiative in the country. Smaller funds, who have a similar investment thesis, they don't have that capability or that capital to be able to start their own verticals in India. So, to some extent, we are giving them a platform via which, we do all the sort of asset sourcing, negotiation, and on-ground execution, and they'll basically start taking up parts of our AIF. So, it's a concept called fund of funds,
right,
where we are talking to many institutional foreign funds to sort of come and participate in our AIF. So those are one type of investors that we are focusing on. The next is institutional grade family offices. So, when I say family offices, yes, these are effectively offices that manage wealth of a single family or a small circle of very ultra HNI families. However, in terms of operation, they function like a mainstream fund. So they have their own IC, they have their own investment guidelines such as the SEBI requirement.
right.
But they also understand risk that comes with real estate when you go into under construction and late stage construction. So we want to only sort of distribute this product or propose this product to people who are comfortable and who understand the kind of investment strategy that we are trying to cater to them.
Right. And it's interesting to me that you spoke about the ability to raise funds from foreign investors. For example, I think in our last conversation we also spoke about how the India commercial real estate growth story and the kind of rental yields available have attracted a lot of foreign investment. So what is the value add here as compared to a more REIT or kind of fractional ownership offering for an international investor? How does this How does the value add differ in terms of this AIF?
Sure. So, effectively a REIT, AIF, these are all different investment structures via which one can access commercial real estate in India. Both come with their pros and cons and both coexist. In fact, in other countries where REITs and alternative funds have existed for a long time, and in fact, there's a lot of synergy between both, but I'll come back to that. Overall, like I mentioned, a lot of these private equity funds, their limitation to participating in India is due to the lack of bandwidth, due to the lack of local resources. So, to some extent, you can say that we'll be like, their outsourced capability, who's executing on the ground in India, and effectively they'll be channeling their funds to us.
Right.
So that's the kind of setup that we are targeting. In fact, we've already established partnership with two different funds. One is based out of the US and the other out of Singapore. So, both these funds have sort of indicated a certain quantum of funds that they wanted to deploy in the commercial real estate space in India. They have a certain expectation of return, but they're okay with a slightly higher risk profile as well.
Perfect. And now that we've kind of got that bit clear, I wanted to kind of get into maybe the more, functional aspects of this AIF and ask you, what exactly is the business model? I know that you said that, as compared to the fractional offering, these are maybe properties that aren't providing rent from day one. So how does the property selection process differ, and how does maybe the risk return profile of this product differ?
To address that question, I'll tell you a little bit about how the capital value of such assets works through their life cycle.
Right.
So, when you go in as an investor greenfield, you will be offered a price which is maybe 10 to 15% higher than the construction or replacement cost. So, overall, your downside is very, very minimal because that's the cost it takes to acquire the land and construct. So, you're not really, acquiring stake, you're more like a partner in the whole project. So that's when you come in day one. Now down the line, let's assume that the project completes, but you don't have a tenant in place. You can achieve a better capital value for your investor. So if a property is 10,000 rupees with a tenant in place, without a tenant you probably can achieve 8,500 or 9,000 rupees.
Right.
So it's about trying to identify assets in which you can very quickly tenant the property out and start getting cash flow, and thereby taking advantage of that vacancy arbitrage. So, usually the execution lies in the fact that if your leasing takes too long, then the time value of money catches up and effectively your capital value will become unviable.
Right.
But if you can lease out very quickly, if you have a strong leasing capability in-house, which we recently developed, then this becomes a very interesting play whereby currently on a pre-leased asset you'd get about an 8% return. If you're able to acquire a vacant asset and uplease it, your returns might be 9.5% plus. So, it gives you a huge margin to play around with.
Right.
I thought I would just, take something you said, which you talked about the leasing synergy that you guys have now, sort of got this capability to lease these assets out. Could you maybe break down a little bit of the process of setting that up and how that's become an added sort of vertical to you being able to move into the AIF space?
Sure. So, one of the main parts about commercial real estate is the leasing, because that's how you sort of establish cash flow in your assets. So what we do is, we are constantly in touch with corporate and, large MNCs, especially when we identify that they have a lease which is already expiring. So at that point in time, we are able to step in, give them competitive offers in different assets that we've identified, and build that relationship. So, in time, we've got a lot of these relationships. We have tenants with us who have, now expanded from one location or one of our offices into various of our locations. So, they are also happy with us being their landlords. We do a very professional job of it. We are very mindful of their needs, and we're constantly trying to, play a fine balance between delivering to our investors and also keeping the tenant happy. So in the long term, this enables us to achieve a very good asset performance. And that is sort of, that is evident in our current portfolio. To date, despite of the lockdowns, 0 of our tenants left. In fact, we have 100% portfolio occupancy rate. No tenant, took a discount or didn't pay rental during lockdowns. We got 100% rental collection as well. So, this is the whole effort that we put in to establish this network. Now, apart from this, the second part of leasing comes in based on your, channel networks, which basically means brokers, wealth managers, international property consultants. So a lot of times, larger MNCs give mandates to such partners of ours, and we preemptively work with them on a day-to-day basis and identify opportunities in which we can sort of help these tenants and also secure lucrative deals for our investors.
Right.
Right. Aryaman, just a small follow-up to something that you mentioned now. You said that in terms of marketing, you'll look at maybe wealth managers and channel partners and stuff like that. So I just wanted to ask you that for the retail investors, is there a space in the, is there a space in these AIFs as well? Or is it going to be, 100% institutional only?
So see, we do have a provision for retail investors. The main difference, I would say, in sort of categorizing them as retail in the same breath as what we do on the fractional platform, lies in the fact that the SEBI mandated minimum investment amount in an AIF is 1 crore of rupees. So, that's a very different bracket when your minimum goes that high.
Right.
In fact, whilst we say, we are open to retail investors, even those retail investors would be deploying via family offices or structured funds. Because usually when capital goes that high, investors do have an in-house framework in place.
Right. And what's interesting is now that you're talking about how the minimum investment is almost 4 times what it is for MYRE's fractional ownership platform. Wanted to touch base on, so we talked about the leasing angle and you talked about the investors' risk appetite as well, but what are the sort of value additions for outside of the fact that MYRE has a great network with MNCs who look for leasing or with channel partners who look for leasing? What are the sort of other value additions that either with the properties or with MYRE that the investor gets?
Sure. So, we add considerable value through the whole life cycle, all the way starting from the sourcing of assets. So, we have a tech-driven approach whereby we are evaluating more than 500 different unique properties every month pan-India. So, we have a huge in-house data capability whereby we analyze micro-market lease, rentals, capital value transactions, end-to-end everything. And thereafter, we come up with a shortlist. So, being able to come up with a good asset base, I would say, is our key strength. Even currently, our portfolio has some of the most marquee assets in the country and acquired at very, very attractive capital values. So that is one of our capabilities. Then, between sourcing and, let's say, closing the transaction or financing the transaction, there are many other intermittent steps like, legal due diligence, structural evaluation, market benchmarking, valuation reports. So, all of this, our team sort of does on an ongoing basis and across numerous assets. So out of every 20 or 30 properties that we shortlist, only 1 or 2 meet our selection criteria. So it's a very strenuous job being able to find the right asset and stitch the right deal, more importantly, because every property sort of comes with a if and a but if you're acquiring it at an attractive capital value. But then it's our job and our value add to try and figure out if we can sort of fix that problem that currently persists. For example, one of the common issues is that there's no tenant in place, or another issue is that there is a tenant but he wants someone to finance his fit out as well. So there are quite a few things that move in parallel when trying to secure a good deal, and effectively our team does that on an ongoing basis. So by having all these variable capabilities in-house, all the way from tech, data aggregation, leasing, asset sourcing, distribution network, they work hand in hand to stitch the ideal deal for the investor.
Right. And now we've through this covered the process of putting this portfolio together for the investors, but I wanted to ask you from a kind of more long-term perspective and an operations perspective also, perhaps, how is running this AIF different from, say, a fractional option? Are there planned exits for these commercial properties that you guys are investing in, or is it more of a long-term, rent collection sort of business operation then?
So we are currently still finalizing the absolute strategy of the AIF, because in the AIF you can deploy various strategies. So you can allocate a certain percentage of the portfolio where, let's say, you'll say that I'll hold these assets for a long term.
Right.
The remaining part of your portfolio, you can say that I'll acquire slightly riskier assets with a higher potential of return. But these will be, ways of sort of realizing appreciation in very short durations. So I'll give you an example. So if you acquire a building, let's say with a 6 months from completion, you'll get a very attractive capital value. If you're able to lease it, in a competitive time frame and exit the asset, because leased assets are far easier to exit, then within a year you can realize a lot of appreciation and churn that capital again.
Right.
So we are going to be adopting a slightly more aggressive strategy in the AIF with the intent of delivering 25% plus returns. But this will come, like I said, with an added risk of execution of real estate and all these things.
Okay, that makes sense. And since you talked about the the more aggressive strategy that you are leaning towards with the AIF, and also the fact that the clients are sort of more pro risk rather than risk averse. One of the things that you touched upon, which is the entry point for the AIF, is earlier than it would be for the fractional ownership offerings, correct? And wanted to ask you, how early do you mean by early? Does this mean that even something that's under construction or maybe getting completed within the coming year would be an option for the AIF to invest in? Or does it have to at least be completely constructed and bare shell? What stage do you typically look at?
Sure. So at present, what we are anticipating is having 50% of our portfolio in similar assets as fractional, which are pre-lease, stable, rent yielding. So that will be the core asset of the fund. 20% of it will be assets that we identify which are distressed, which means that the building is complete, it's ready for tenancy. However, the developer or the landlord hasn't been able to identify a tenant, and in these assets, quite often there's a loan component as well. So, despite the asset not generating cash flow, these landlords have to continue paying banks, which eventually leads them to a situation of distress. So 20% of our portfolio will be vacant assets that will identify at attractive capital value and then, uplease them and exit them. The 20% will be late stage construction. So late stage construction are marquee developments, which are 6 months to 1 year away from, completion and tenancy. So those are the slightly riskier ones. However, in these kinds of developments, the developer has already invested significant capital into getting the project till there. So 3 years of construction has completed. There's a lot of skin in the game. There's a lot at stake. So usually such projects tend to not be problematic.
Right.
We are currently looking at greenfield, but very, very selective greenfield. Only 10% of our portfolio. When I mention greenfield, that means day one we enter as an equity partner into the project.
Right.
We will only be tying up with the top 3 or 4 developers of the country with a demonstrated execution capability and track record.
Right. And since we're talking about the more general trend of AIFs, I wanted to get your opinion on this as well. That your AIF currently is going to be commercial focused, right? And we've started to see maybe specialized AIFs for things like warehousing and that space as well. So do you see AIFs becoming a larger trend and coming up for other asset classes and sectors within real estate as well as a niche opportunity for HNIs, family offices or institutional investors?
No, absolutely. In fact, relatively, AIFs are a very new structure in India. So, if you compare it with other investment structures proposed by SEBI, this is still very new. So we have only a handful of, when I say handful, a few hundred AIFs in the country, of which a small percentage of them are based on real estate.
Right.
So, this whole framework is just getting started in India. I think that the relationship between fundraising, AIFs and real estate in time is maturing, and it's going to be a huge boost for the real estate sector. We are seeing increasingly people coming up with niche AIFs in the real estate space, and that has really jolted the entire industry. So overall, even we are looking at participating predominantly in office space, but we will be looking at opportunistic acquisitions in student housing, in hospitality, in warehousing, industrial. So again, that will be a portfolio split. So, maybe 60-70% of our portfolio will be office space, and the remainder will be spread across, opportunistic acquisitions in other parts of commercial real estate.
Right.
Aryaman, the last time you were here and we spoke about fractional ownership, you talked about how a lot of the properties that you all are working with for the fractional ownership side of MYRE can eventually maybe become feeder for like REITs. But we talked about how an AIF is primarily for institutional investors. We talked about how there are various strategies you could have for exit as well. So do you feel that there may be opportunities for retail investors in real estate to, at some point in the future, have a share or have a stake in the AIF game?
So see, there's a lot of synergy between all these different investment frameworks, from the AIF to the REIT to fractional platforms. Now, the one thing that varies is the investor that you're catering to, and the amount of risk that they have an appetite for. So I'll give you an example of a certain synergy that we are looking forward to. In the AIF, like I mentioned, we might be taking projects which are late stage under construction. So, something like that today is not an ideal proposition on our fractional platform, because, there's still a considerable amount of risk and there is no tenant in place. However, once that asset is stabilized in our AIF, then, it could become a very strong proposition for our fractional platform to acquire at, let's say, 8% yield. So, that way, giving good assets to our fractional platform and giving, predetermined exits to our AIF. The reason also this would be very beneficial for our fractional platform is that, most of the very, very marquee assets in this country get bought out by institutional investors and AIFs prior completion. So right now what is happening is that, because we are going for core assets which are completed, we are operating in a smaller pool of assets for our fractional platform.
Right.
Tomorrow, when we have the capability of picking assets from a riskier pool and stabilizing them, and thereby offering it to our fractional platform, the overall synergy and the asset pool becomes far more lucrative.
Right. Perfect. And if we could just take a step back, and I think we discussed this in our last conversation as well, but I just wanted to sort of get an updated opinion from you, if you will. We've seen so many real estate investment or financial products coming up, right? And now we've got a real breadth of these products in the market for different kinds of investors, going all the way from small size, ticket size retail to, HNI, family office, and institutional, through fractional ownership, AIFs, and everything like that. Are there any other products or opportunities that you see being exploited for financial products in real estate in the future? Or do you think that we're kind of seeing this ecosystem mature a little bit now?
So see, I'll tell you, there are two parts of investing in any asset class, and likewise for real estate: debt and equity.
Right.
So when an asset class is maturing, when there's consolidation in the asset class, like we're having in real estate today, where it's far more organized, there's a framework provided by the government for investor safety, there's RERA, and things like that. What you see is increasing amounts of equity investments. Debt is still limited. The reason for that is, debt is far riskier, whereby you could lose your principal amount as well. When you're buying something with equity, you effectively become the owner of that asset.
Right.
So, immediately you have that asset in your possession. If you see foreign markets, let's say like the UK, debt is as active as equity in the real estate market. In India today, debt is number one, not even a small fraction of what equity is. More importantly, the kind of risk that comes with debt in India, and the perceived risk also by investors, is something which is not ideal for an investment product. So, as the market matures, as we continue to see growth in the real estate sector, I do feel that the debt investments, such as providing mezzanine debt to developers, last mile funding, these kinds of products will also sort of come to fruition.
Right.
That makes sense.
I think that covers a lot of the, more AIF specific questions that we had. But something I thought that I could ask you about, MYRE as a business. So you founded a very new age kind of real estate company that has a tech element, that also has a service element to some degree. So I just wanted to ask you about the journey of MYRE as maybe a startup. You've recently switched, your home base as well. And I wanted to know what your experience has been like through the growth of MYRE over the last year and a half or 2 years.
So it's actually been very interesting because, real estate is a very large asset class.
Right.
However, a lot of the platforms that you see online today are transaction based. So they're not guiding you towards real estate investment. They're mostly for end users. You take no broker, housing, Makan, Prop Tiger. All of these are sort of brokerage transaction platforms where they simply list the asset and then connect the stakeholders.
Right.
So there's a very large gap in enabling people to invest safely in real estate and the avenues via which they can do so. So that's something that we've identified in the last 1 year whilst we've been operating in the space. And what we are trying to do is give a very professional platform, give a platform which has a demonstrated track record with investors as our key stakeholders. We are trying to give them unprecedented access to traditional real estate investment opportunities, which have been dominated by a very select few of people in a safe manner. So your larger funds, Brookfield, for that matter, Blackstone, Keppel, all of these large funds have a lot of exposure in commercial real estate in India, and we are trying to see how we can sort of safely position that to a much larger base of investors. So it's been a very interesting journey. In fact, we've been trying to do innovative things month on month. We've been trying to grow month on month. In fact, today our team size has tripled from the last time that we spoke as well.
Wow.
And this is predominantly to support the increasing number of verticals that we're offering.
Fantastic. Aryaman, now, as we come towards the sort of end of our conversation today, one of the things that we thought we could ask you, maybe a bit of a teaser for our listeners to look forward to when it comes to the AIF space or the real estate investment space, is what are the hot markets for AIFs in India?
Each market comes again with a different risk-return proposition. So, for example, let's say you go invest in a tier 3 city.
Right.
Your return potential could be in multiples. We've seen land in tier 3 cities 3x in value in a very short duration. But again, you might also come across a situation where there is no significant development for years to come and your capital doesn't appreciate. It may even depreciate. So, if you go to a tier 1 city, on the other hand, it will be far more stable. Your appreciation won't be 3x, but it'll be far more controlled and it'll be far more predictable, to say the least. So, that's the sort of trade-off when it comes. We ourselves are predominantly going to be focusing on tier 1 cities and fast-growing tier 2 cities. So, NCR, Pune, Chennai, Bangalore, Hyderabad, Mumbai. Cities like this, which have an active commercial hub situated in them already.
Perfect. So, I just wanted to get your opinion on this. Currently, because of events all around the world, we're in a really high inflationary regime, especially in India. We're seeing in maybe wholesale, especially double-digit inflation nowadays. So, I just wanted to get your opinion on real estate as an asset class in times like these.
Sure. So, that's a very interesting question. Now, I'll tell you historically what has happened. Whenever inflationary pressures are high, investors increasingly gravitate towards hard assets such as commodities, gold as an example, or real estate. The idea really is that hard assets, serve as a safe haven, as a hedge against inflation. Real estate also, for that matter, all your rental agreements are linked with inflation. So your rental appreciates or escalates year on year,
right?
Based on the country's average inflation rate. So, to that end, I strongly believe that, where we are today in terms of the economy and inflationary pressure, we are going to see a massive appreciation or growth in the real estate sector in such countries.
Right.
Perfect. So again, this is a more general question about the commercial real estate and the real estate investment landscape. But we've seen so much securitization in real estate in India. Yash alluded to it during the conversation as well. Just a sort of your opinion, do you think this is the start? Do you think that the accessibility for the investor is what has really increased? And what kind of other avenues do you foresee in the coming future?
No, absolutely. I think that one thing that has really rampantly grown in the last 3-4 years is the entire fintech proptech space. Pre-2019, yes, there were platforms which enable such investments, but they were not operating at the scale today, or they were not even being utilized at the scale today by investors. So, in a post-pandemic era, investors have become far more tech-savvy in general. they are more open to sort of evaluating and confirming investment opportunities on digital platforms. And in turn, that enables us to also translate a lot of the cost saving to investor returns. So the symbiotic relationship between asset manager, investors, and the developer is something which is really maturing with time. So yes, I think there's a lot of scope in the various parts of real estate that investment can help grow. For example, there's, like we spoke about, equity financing, there's mezzanine debt financing. Apart from that, there are also a lot of supplementary parts of real estate where innovative products have come up. For example, fit out financing for the tenants. Now, fit outs are a very large capex for tenants, which quite often deters them to open large offices.
Right.
And the interest rate is extremely high. So fit out financing via retail investors has also become a very attractive fixed income proposition.
Right.
So to that end, we are seeing a lot of the issues in sort of financing and real estate being resolved via the power of masses and retail investors.
Right.
Perfect. I think with that, we've covered all the short questions that we had as well. Thank you again, Aryaman, for your time. And I think it's safe to say that both Akshay and I are looking forward to the launch of this AIF and to see the growth journey of MYRE continuing over the next year and hopefully years to come.
Yeah, absolutely. A big thank you again for another insightful conversation. It was really lovely speaking to you again and having you back on the show.
No, absolutely. It was a pleasure talking to you again, Akshay and Ash.
If you enjoyed this conversation, be sure to follow Concrete Conversations on Instagram to know more about upcoming episodes and for some behind-the-scenes content.
For more deep dives into the world of Indian real estate, stay tuned for more Concrete Conversations.